Nice to have you with us on this Tuesday morning, and there are two dominant stories the stock market is watching. We just talked about one of them, earnings reports, but the other is central bank action. It's going to be a busy week. You've got the ECB, the Bank of Japan with central bank decisions, but the U.S. Federal Reserve may get the lion's share of the attention, and a lot of people are expecting that the Fed will once again raise interest rates, but at this point, most of the market is anticipating if inflation cools down, perhaps the Fed is closer to the finish line than the start. We are navigating that same storyline here in Canada as well. Let's talk to Thomas Simons, who's a senior economist at Jefferies, to get a preview ahead of the Fed decision. Thomas, nice to have you with us. Set the stage for us. What are you expecting tomorrow?
Hey, good morning, and thank you for having me. Yes, so as you mentioned, we're along with the big camp out here expecting that the Fed is going to raise rates one more time here at the meeting on tomorrow. I think that Powell is going to want to do something very similar to what he did in June, which was to balance the issues with having a very tight focus on data dependence and how that, how the incoming data is influencing policy, while also taking a longer term view, trying to assess what the impact of the lagged impacts of previous monetary policy actions are, sort of how far along we are in that process. So far, it seems like that what they've done is try to strike a balance with showing that they're slowing down the pace of rate hikes and now taking an even longer perspective. So it's not just, going from 75 down to 50, down to 25, but now thinking of it as, once every few meetings, we might be raising rates again, doing some of the fine tuning on the end of the cycle. So without an SEP, without the dot plot, it's difficult for them to really change too much in terms of their guidance. But I do think that Powell is going to stick with his data-dependent approach and leave the door open for another hike later on this year if they need to.
Dot plots at least give us a sense of what's happening behind closed doors. Do you think there's going to be an interesting debate that grows, especially if you see more signs of inflation pressures easing?
Yes, I think we already have started to see the first signs of that, actually, in some of the public speeches that a couple of policymakers have made over the last few weeks. Obviously, we're in the blackout period now, so there hasn't been anything, within the last few days. But certainly since the meeting, it seems like there's an emerging camp that thinks that maybe rate hikes aren't necessary any longer. I've heard comments to that effect from Atlanta Fed President Bostic, and I think to a lesser extent from Chicago Fed President Goolsbee as well. There are still the hawks. There are still some that are talking about raising rates even more than 2 more times this year. But I think that it's, very possible those camps are going to start to, distance themselves a little bit more from each other as we go on here. And we could even get a dissent at this meeting. I don't think that necessarily means that we're, that the policy reaction function is changing that much, but certainly as we're getting dissents and more disagreement, it would suggest that we're close to the end of the cycle for sure.
The other thing that the market is trying to figure out right now is whether or not, as the economy has been resilient to this point, and if we are getting closer to the end of rate hikes and there are signs that inflation pressures are easing, should we be not just backing away from the idea of a dreaded recession, maybe being pushed into next year, but the idea that we should be having a conversation about recoveries already. We had a Wall Street bull yesterday on Bloomberg, Ed Yardeni, who talked about, in his view, already shifting from a rolling recession, in other words, some parts of the economy, to now being in a rolling recovery.
Certainly, the debate is picking up about that, and I still remain in the camp that we are going to end up with a recession later on this year. But I think that, part of why there seems to be this capitulation of people sort of giving up on the idea that there might be a recession, excuse me, and expecting that, we are going to have a more prolonged expansion is that we're very accustomed to what happened with the last 2 recessions, right? So with the pandemic, we had this sort of immediate shutdown of the economy with, very highly correlated declines in all different sectors. And a similar issue, with the financial crisis in 2008 and 2009. Those are catastrophic events. They were not the product of a, sort of extended cycle of expansion that then, leads to the Fed over tightening and then, more of a classic reaction with the recession. These are the cycles. What we're seeing now is similar to what we saw in the 70s, 80s, and the early 90s in terms of, again, this sort of classic model of the recession. And what this also includes is this transition phase, which we're in now, where we have certain areas of the economy that are doing well, others that are doing poorly. And I don't think that it's appropriate to look at that short-term evidence that we're seeing now and say this time is different, that we are going to get this sort of, infinite expansion. I do think it's more appropriate to kind of look at those previous examples and set expectations accordingly.
Well, before I let you go, obviously you're tracking the economic data and not necessarily each move in the stock market, but the bond market versus the stock market has been very interesting. A lot of people felt uncomfortable with the the inversion of the yield curve, but I think just based on what you're saying, maybe it's just more of a message that not necessarily we're headed for a worst case scenario for the economy, but that there are signs of inflation pressures easing, and that conversation is going to continue, especially if you get more hawkish messaging, let's say, from the Fed.
Yeah, I think that's right. We are seeing, quite a bit of evidence that inflation has come off the highs and that we don't have to worry about persistently, 5, 6, 7, 8% year over year inflation going forward. The issue is, are we now at a point where we're kind of stuck with 3 to 3.5% year over year inflation, which is too much for the Fed. So, I don't think that I think that the bond market rather is looking at it like, OK, we don't need to price in these kind of worst case scenarios with further and further rate hikes into, higher and higher ranges for rates. But rather now it's just how long are rates going to be high? The stock market, I think, is more kind of focused on just how well companies have responded to the environment that we're in. Certainly, we're talking about these stronger earnings reports we've been getting recently. Yeah. And, it's more of a just single name by name kind of thing. The bond market, I think, is just more sort of looking at the longer term inflation environment and how the Fed is going to react.